present the risk assessment and maturity for Coal Hub Construction Company. So we speculated that the Coal Hub Company having the high inherent risk and high control risk. The high inherent risk is mainly due to the fluctuating sales, poor liquidity, low profitability, and high liability. Also, high control risk is mainly due to the segregation of duties. For the high inherent risk factors, for example, fluctuating sales, as we can see from the graph here, the company is, since 2008, the company revenue has dropped drastically from 91,000 million to 59,000 million. And this is because of the 2008 financial global crisis. This is it decreased the demand for construction in both developed countries and developing countries. And although there's a slight increase in 2012, there's a 10,000 increase of revenue, but it is increased at the expense of cost of goods sold, which means that they increase the revenue at the same time they increase their cost of goods sold as well. This can be proven by the gross profit margin. Both years for the gross profit margin is negative 6% and 3%. And another factor is poor liquidity. The low current ratio indicates that the company do not have enough assets to convert into cash to pay up its short-term debts. Also, during the bankrupt, when company going to bankrupt, they is not able to pay up all their liabilities. This is one of the reasons why the company has listed to PN17 due to the inefficient liquidity. Hence, there is a high possibility for the management to commit fraud. Another factor is the high liability. The company was having the negative debt to equity ratio, which means that the company was having too much debt over the equity. The reason is because of the substantial losses accumulated since 2009, as the company was keep on having the losses in the past few years. And although in 2011, the company was already reduced capital issue, but in 2012, the next year, the company was still having a negative profitability. And the company is threatened by the high liability in the foreseeable future, which raised a question on their going concern assumption. For the control risk, we speculated to be high also because of the segregation of duties. For 5 years, bad performance of poor liquidity, the most effective way is actually to downsizing. As you can see from the annual report, the company actually cut down the total staff cost from 6,000 million to 4,000 million. And portion of the employees will be being laid out, but their job still needs someone to take over. So the existing employee may have to in charge of more aspect of responsibility. So it creates the opportunity for them to create collusion, fraud, assess misappropriate. So next we'll talk about the maturity. We will use the total asset as the base amount for the planning maturity because it is relatively stable and it is representative of the entity size. The reason why we don't use profit before tax, even though it is the first choice for every audit firm, is because the profit before tax was negative and the second choice revenue was unstable as well. So we use the total assets base 103%, it equal to the 5 million. And the percentage is set to be low as a result of high audit risk, which indicate that there is a high risk for auditor to express inappropriate opinion when the financial statement is misstated. Also, the low maturity indicates that the auditor need to perform more audit work to lower the audit risk to an acceptable level. The tolerable misstatement is the figure of the individual account can be different from the true amount without having impact on the fair presentation of the financial statement as a whole. So the lower tolerable misstatement, the more extensive audit works. So the tolerable misstatement we will set to be 25% of the planning material, which is the 1 million, approximately 1 million. Thank you.